Thank you. And thank you to everyone for attending, and thank you, Jack and Sean, for obviously putting this on as well. It's really appreciated. So, just a little bit about navigating and who we are. So, we're an outsourced commercial finance team for our clients. What that essentially means is we help businesses source the most appropriate funding, whether that is for growth or whether that is for through a bit of a sticky patch through the period as well. We can help them source the most appropriate funding. Who's involved in the business? So on the top table, the board, we've got Paul Varley, who's our managing director. He's been in finance all his career, predominantly invoice finance for the last 20 years. He has worked in independent invoice finance lenders, which actually, when he launched the Birmingham office for a lender, got sold to Santander, and that became Santander Invoice Finance. So very well experienced on kind of all sides, really. Then we've got two non-exec directors as well. One of them being Steve Stokes. He launched the Birmingham office for FRP, which are insolvency practitioners. He's now semi-retired at 46, 47, which is nice if you can get it. But he's no longer licensed. And with Steve, he's a really common influence, a great person to have on our board. But when we come across a business where perhaps putting in more debt doesn't feel right, doesn't feel the right solution for that business, Steve can have a half an hour conversation with them. He's not a threat. He's no longer licensed, and just really tell them what their options may be. Certainly if they've got personal guarantees on the line for loans and things like that. And then we have another non-exec director as well, which is Richard Griffiths. He's head of corporate at Higgs and Sons over in Brierley Hill. So buying and selling businesses all day long. Again, Rich looks at our governance for us. And when we come across opportunities where our clients are either looking to buy or sell, it's a fantastic person to have on board, and we can bring Richard in to have those conversations as well. Also involved in the business, myself, I've been here for over 2 years now. I've done sales and marketing and supported business for well over 12 years. I know I don't look old enough, but I promise you I am. And then we've got Ian Gardner, who we've recently just brought on board as well. So Ian looks after, he's been a phenomenal networker, great contact base in Lichfield, Tamworth and Sutton Coldfield. So really, really good to have him on board, and a great coup for us. And then we've got Liz, who looks after our back office and admin. She does all of the hard work, shall we say, but she keeps me, Ian, and Paul on the front foot. Anything that has me crying in a corner with admin wise, we fire it over to Liz, and she's brilliant at that. Everyone needs a Liz in their business, believe me. So just moving on to the solutions. I won't go into all of these in great detail, of course, but what this slide really is to show is there are lots of different solutions out there when it comes to raising finance and raising debt. And there's also behind each solution, there's lots of different lenders with appetite, criteria, and all that kind of thing as well that goes into that. So our job and the way that we work is when we're speaking to a business, we will just ask questions. And I know that sounds very simple, but the more that we understand your business, your challenge, and what you're looking to achieve, that gives us then the ability to say, well, based on everything that we know and everything that you've told us, this is the right solution or blend of solutions, and this is the right lender that we can approach, so we feel that you sit within their appetite. What that does is we spend a little bit more time on the front end asking those questions, but what it does do is speeds everything up on the back end, and everyone is on the same page when moving forward. In terms of stats and about the sorts of businesses that we help, manufacturing is our biggest sector. Naturally, we're in the West Midlands, and also manufacturing, they've got heavy fixed overheads. I'm preaching to the choir here, but heavy fixed overheads, and typically their customers can take 60, sometimes 90 days to pay, which again causes cash flow pinches. There's also when you're winning, and we'll go on to triggers and things, but when you're winning orders and stock raw materials that you need to buy and all that kind of thing, really. Those who are eagle-eyed would have seen a little PP Plus logo in that manufacturing and thought, what the hell is that? So we're part of PP Plus Control and Automation. They're a big manufacturer based in West Midlands. They've set up a fantastic initiative to help support manufacturing sector and manufacturing businesses with things like cost-effective outsourcing, financial help, legal help, that kind of thing. They've got lots of partners, and we're proud to be one of those partners with PP Plus as well. And then if you see our other sectors, construction, again, I won't go into too much detail. It's more about manufacturing today, but notoriously difficult to fund and need people like ourselves. Then on the right, where you can see, so what we've got there is we completed 22% of opportunities that we see, and we've also got 1% sitting in what we call lender credit approved. Brass tacks, what does that mean? So just shy of one out of every four opportunities that we see, we get our clients a credit-backed offer of finance based on what their challenge, what their needs are. And again, moving on to the solutions that we do use, invoice finance is just shy of one out of every three opportunities that we complete is invoice finance. Why? Well, again, coming back to the types of businesses that we work with, manufacturing, as we've already alluded to, heavy fixed overheads. Customers can take 60 days, sometimes longer, to be paying. So all of their cash can be typically tied up within their debtor book. Well, invoice finance gives them the ability to draw down on that debtor book and get the cash back quicker, gives them the ability to invest in the growth, but also also pay suppliers. And the sexy side, if there is a sexy side to invoice finance, if you can pay your suppliers off quicker, if you can pay on the nose, then can you get a bigger discount? Can you do it? Can you work that invoice finance harder for you and increase your margins that way? Our second biggest is cash flow loan. Again, that can be used for growth, or whether you are hitting a bit of a softening in performance and you can see the runway and you're going to improve in sort of 3 to 6 months' time, then a cash flow loan could be put in place. Again, you can use those funds to buy stock, pay suppliers, all that kind of thing, really. And then the other side of it as well or our third biggest is asset finance. Again, if you look at the clients that we work with, manufacturing, construction, etc., they need to buy plant and machinery, and rather than going into their reserves or using a vast amount of their reserves, they can spread those costs over a 3 to 5 year period, shorter if required. But on the other side of that as well, and we'll come on to it in the case study, with asset finance, if you are looking for a cash injection into the business and you have some unencumbered kit, then what you can do is refinance that asset to then get that investment into the business, really. And because it's typically secured against an asset, the rates you can get can be better than a cash flow loan. I'm not saying all the time, but they can be better depending on the kit, depending on that business, and depending on what the financial performance of that business is. We get 99% of our work from the intermediary market, so it's professional services. And as you can see, accountants, banks, and brokers are our big three, and funders that aren't not banks are the independents. Accountants, why? It's probably very, very, very obvious, but the first person that you turn to when you have a financial need in your business, of course, is your accountant. And the good proactive accountants, when they're sitting down with you as well, will envision when you're going to have a cash flow pinch, when you're going to have a finance need. We also, again, banks, I think there's another webinar in February about this, but they are saying no a little bit more because of everything that's going on in the economy. And it's not the easiest to get finance from banks. So what we do is we help support their clients when they can't support. They pick up the phone to us, we have a conversation, and what we can help them do then is find their client a solution to help with their finance needs. And then, brokers and funding up bank, again, we get opportunities from brokers and from independent lenders where, again, either brokers can't find a lender to support, and or lenders doesn't sit within their credit appetite. We may know another lender, another solution, another way to go around that. Another way to do that opportunity and that finance opportunity for that business. Moving on to some of the things that we hear from manufacturing businesses and or introducers, sort of big five, really. Growing pains. Again, growth is great, but it can cause cash flow pinches, and that may be and kind of links in really with winning a large recent order. If you win a large order, of course, what you have to do or may need to do is buy a new machinery to service that. You may need to buy raw materials, stock, supplies, hire new staff, however that may look like to deliver that contract or that order. That is part of those growing pains that we hear businesses have quite often when they are growing. That really lends itself again, cash pressure. COVID, and we've got a case study about this, but COVID being a prime example, a softening in performance for factors outside of their control, that's going to cause cash pressure for any business. Is there assets? Let's play to our strengths, is the phrase that we coin. Is there unencumbered kits? Can we look at invoice finance? Is there cash flow loans? Is there a commercial property? Again, and this is why we ask so many questions at the beginning, not that we interrogate you by any means, but we just, one, we're interested, and two, the more we learn, the more that we can understand and find the solution for you. And then again, new plant and machinery, very, very, very basic, but and very obvious. But if you need to buy new plant and machinery rather than using reserves, and then refinance, I think this is a big one for me, and it's something that we're certainly seeing a lot more of. There's been a lot of change over the last couple of years. You've had COVID, you've had budgets, you've had mini budgets, big budgets, you've had political turmoil, you've had all sorts of going on over the last couple of years, and you may have had a finance facility or finance structure in place over the last 3-4 years that you're busy running the business, you're busy with hundreds and hundreds of different problems a day, I imagine. So looking at your finance structure sometimes just keeps falling to the bottom of the to-do list. And we offer and it's something that we've been toying with putting on the website and things, but we do offer a free finance review. So we'll ask questions, we'll get the information, and what we'll do is just see, prime example, is your invoice finance facility still the best structure and keenly priced as it was when you're first taking it on? Is that still the right invoice finance or the right lender for you? And if it is, we're not going to waste your time. We're not going to waste our time taking it to lenders either. We're going to tell you, yes, this is still the best lender for you. And all you've done there is used a little bit of time to send us information, but then you've had that verified by a third party expert. So moving on to some case studies. So we worked with a manufacturer for recycled businesses, for a recycling business based in Wolverhampton. They invested significantly into machinery, plant machinery themselves using their own cash. But what they wanted was a facility for working capital. So when they started orders, we put an invoice finance facility in place for them. So when they started generating invoices, that gave them the ability to draw down on those invoices within sort of 24 hours rather than having to wait 60 to 90 days for those customers to pay. That gave them then the funds to fund wages, overheads, all of that kind of thing as well. The second one, a cash flow loan. So again, this is one of those growing pains. We had a manufacturer over in the East Midlands, but they had a swelling order book, and what they needed was to buy raw materials in order to fulfill those orders. So there was no unencumbered kit. There was asset light in terms of unencumbered assets that we could use as leverage. So as security. So what we did was we put a cash flow loan into that business. And what that does is they can go and then buy the stock and raw materials that they needed, spread those monthly repayments over a 5-year period. There are lenders as well that there's no cost, no early repayment fees. So if you think you're going to pay it off quicker, you can and save on interest. But for these guys, they can spread it over 5 years. That helps with their monthly cash flow because the monthly repayments were lower, and then they can go on and quickly go on and grow that business again because they've got the stocks and raw materials they need. And again, with a cash flow loan, because it is the cash injection up front, again, can you have a conversation with that supplier to say, look, if I pay all of this on the nose, can I get a 5, 10, 15% discount, whatever that might look like? They may tell you to sling your hook, but it's worth asking the question. You never know. You may be able to get a slight discount there as well. And then the last two case studies. So yeah, and asset finance. So this was actually an asset refinance. It's a business that we've worked with for a number of years, or our MD did for a number of years. This is where, again, during COVID, because of the sectors that they supplied, automotive, aerospace, defense, and various commercial sectors, COVID, the performance softened naturally. They had a real tough, this business had a real tough time during COVID, unfortunately. But as we come out of COVID, they they were growing out of COVID. The order book was filling quite quickly, and they were getting lots of new orders in over a short period of time. So again, what they needed was raw materials and supplies. But what this business had was a CNC machine that was unencumbered. So what we could then do is use that asset, again, play to our strengths, use that asset, refinance to release some equity out of that asset. They can then use that cash to go and buy the raw materials and supplies that they needed. Again, you can put those monthly repayments over 3 to 6 years, shorter if required, but it helps with their monthly cash flow whilst they are just still trying to um, recover from that performance in COVID. Again, no fault of their own, but it helped them get those stocks and supplies they needed then to fulfill those orders and really grow again. And then the last one, which is a revolving credit facility. Now, this is a really interesting case study and an interesting solution. I promise you it is interesting. I know it's finance, but I promise you it is interesting. This one is so this business, they had been approved for a grant to buy a new piece of kit, but part of that grant is they had to buy it outright without using their own cash. Now, a revolving credit facility in old money is an overdraft. So the way that a revolving credit facility would work is you have a up to a certain limit, so say 150,000, for example, you can draw up to 150,000, but you only pay for what you borrow, and the interest is calculated daily. So for this business, they knew that they had this grant, they've been approved for it. So they drew down the funds required from their revolving credit facility was secured for them. They paid for that piece of machinery. When the grant money come back into their bank account, they paid everything that they owed on that revolving credit facility off, and the interest was calculated daily, so it would have saved them on interest rather than a cash flow loan or asset finance that would have been over a 5 year period. They probably had to borrow that for sort of 6 weeks, for example. Then when you've paid it all back with a revolving credit facility, there's no non-utilization fees. So effectively, what does that mean? Well, if you're not using or borrowing from that facility, you're not paying anything at all. It just sits there in the background, ready for you to draw down on it again if you need to. So a revolving credit facility is a great solution if you're borrowing for a short period, or you just want a bit of a headroom facility, as we would say, where you want the comfort knowing that you can take on new orders and you can dip into a facility and then pay that back quite quickly if you've got the ability to pay that back quite quickly. I haven't got a fancy any questions slide, but that is my presentation done. But yeah, any questions, anything, if you just want to run through the art of the possible, anything like that, please do just reach out either phone, email, or anything like that.
I think there are a couple of questions, aren't there, Jack?
Well, we have a question from Mark regarding a gauge on the cost for each products. He says that it seems that nowadays there is no inexpensive funding. What are your thoughts on that, Adam?
So yeah, we get that question quite a lot. What's the costs involved? And it really does vary depending on the business, depending on the financial performance, what assets are available. There's so many variables that go into, and again, the solution. So there's so many variables that go into the cost of finance, and that's why the way that we work is so effective, because we will ask questions, and the more we understand about the business, then we know which solution we can approach, and from there we also know which lenders we can approach, and that helps us then place that in the right way. And yes, interest costs have gone up because the base rate has gone up, but and I know again, I look way too young, but I'm 32. So I left school during the financial crisis. So I'm used to historic low rates, and being 0.25% as an interest rate, we've been used to that for a long period. But if you look before that, it was the base rate has never been that low for that long. So now that it's risen, it does feel like it's getting really, really expensive, but it's kind of going to become the new norm, I think. I know base rates should hopefully, touch wood, come down over the next few weeks, but again, there's no guide to each solution on how much that's going to cost, because it really does. It's so many variables that go into each solution and each business, to be honest. But I'm more, again, the way that we work is we're more than happy. We will invest time with the business, and if we get them indicative terms on a solution and they're not quite happy with it, and they say no, it's too expensive, or it doesn't quite fit for what I need at this time, there's no cost to that. We will provide indicative terms, and we shake hands, we walk away, and we'll keep in touch, and we'll help them in the future if they still need it.
Another question, Adam, is do you believe the government has any finance packages in the pipeline, perhaps to make lending more available or more accessible?
So the government have changed from RLS, which was the recovery loan scheme, to GGS, which is guaranteed growth scheme, I think. But all that's really changed with that is the name. More than anything, it remains very, very similar, and that's more for lenders than borrowers. And by that I mean that although it's now, it will say government backed, the big difference now is unfortunately, if a business goes into a process and goes into administration or liquidation, the lender now has to show that they've exhausted every single option that they can to get their money back from the borrower before going to the government scheme. So they can't just go straight to RLS. So we get this quite a lot. One of the misconceptions about the RLS and GDS schemes are, do I still have to give a personal guarantee? And the answer is yes, you do, because not just because the government have backed it doesn't mean that you don't have to give a personal guarantee. There are solutions out there where you don't, invoice finance being one of them with a couple of lenders, but 9 times out of 10 you still have to give. But in terms of funding packages, I think, not to get political, I think my guess is probably as good as everyone else's guess. No one really knows what's going to come up with Rachel Reeves and what's going to help, to be honest.
I completely understand. One final question from Edward. Do you have an example of interest rates for a 50k limit revolving credit? And of course, this is a general question because I understand it's going to be specific to certain businesses.
Yeah, it varies. So unsecured, for us, unsecured means just backed by a personal guarantee. So with that, the interest rates would be in between 4.5% to 6.5% per month. Now, some of you are going to go, but with a revolving credit facility, as I said, with that, it's calculated daily. So if you were to only borrow that for 3, 4, 5 days, for example, you would only pay the interest on 3, 4, 5 days. If you were going to borrow it for 2 weeks, then you would only pay the interest on 2 weeks. But in general, a revolving credit facility, yeah, it's about 4.5% to 6.5% per month, anywhere in between there, which is again based on the financial performance of the business and different variables as well.
Thank you very much, Adam. Adam's details, like everyone else's, will be made available. I believe Adam has posted his email in the chat as well. I advise anyone to get in touch with any of our speakers today to ask any questions and any follow-ups. I'm sure they'll be more than happy to help you. But thank you very much, Adam.
Yeah, thanks for that, Adam. That was great. Yeah, and again, we'll work with Adam through our support. So if you are looking for finance and you need help with your financial forecasts, don't forget us, because we can help you with that. Revolving credit, that was a good one, Adam. I really like that case study because it's interesting when, you know, that we have a lot of companies that come through that go for the SME grants that will probably be made available again in April that are in that situation, aren't they? So yeah, keep that in mind, like that. Thank you very much.